Over the past 6 months, we have seen quite good price action in markets in general, with stock markets like the CAC 40 being closing at or being near all-time highs, and also the S&P has moved upwards year to date and so forth. And how confident can we be that we still are in a bear market? And with us to discuss that, we have the senior economist Harry Colvin from Longview Economics. Welcome, Harry.
Thanks, Stefan. Well, I think this is a fascinating subject, and I think this bear market, this recession, is very different to the last one. This one is not about economic excess that's built up and is now unwinding, a bit like we saw in the 2007 to 2009 credit crunch, albeit there are some credit crunch type elements evolving here. It's a very different economy to that. We're looking at certainly a US economy that's structurally much stronger than it was in the last recession. This one is not about economic excess unwinding. It's therefore really about financial market excess unwinding. And in that sense, it's a lot more like the 2001 recession. It's probably going to be quite mild, not like 07 to 09, or indeed other major recessions if we look through history. And just like in 2001, it's possible that the housing sector bounces as the financial market excess unwinds and then as the recession occurs. And, I think the key point here is that usually in milder recessions, which are about the unwinding of financial, not economic excess, there's a different transmission mechanism to economic weakness. Housing in this recession is not going to be the primary channel for weakness like it was 07 to 09, although housing, of course, has struggled a little bit. Instead, it's going to be about the unwinding of financial market excess. We've had years of very cheap money that's being rapidly taken away, and we're starting to see the effects of that on the banking system. 3 banks in the US have already failed. We're seeing tightening lending standards. Last night we got the senior loan officer survey credit conditions report out for Q2, and it generally deteriorated further. So credit conditions are continuing to tighten up, and they should continue to do so, particularly for, we think, commercial real estate. There's a key source of vulnerability there in the US, all of which reduces banks' willingness to lend as their balance sheets come under pressure. So the channels of transmission mechanism are different to the last one. Housing, inventories, capex, all of these parts of the economy, they are a concern. But I think the key driver in this recession is going to be the withdrawal of tight money, the unwinding of financial market excess, and also the derating of very expensive equity markets, which will put further pressure, certainly in the financial system through financial markets. So I think the nature of this recession is going to be different. It's going to be a milder recession, potentially with quite a big bear market.
Sounds like we are deflating a little bit of the sort of everything bubble.
Exactly, it's Grantham's everything bubble, and that's the whole point about TINA, isn't it? That there is no alternative, or at least there was no alternative, and so there was an everything bubble, and then you take the cheap money away, money tightens up, and bubbles burst and begin to deflate, and we see a bursting of the everything bubble. It all shifts in reverse. So that's, I think, going to be the fascinating theme for the next 6, 9, 12 months.
And the commercial real estate market in the US, the regional banks have quite a significant exposure to commercial real estate. Could that sounds like that could become a bigger problem for these already sort of dented stocks?
Yeah, absolutely. So the regional banks have got about a 30%, 30% of their loan book is in commercial real estate, and much of commercial real estate, of course, is offices. Vacancy rates in offices are in the major cities in the US 20% plus. We think they could be a little bit bigger than that, depending on how you want to try and measure it. So there's a huge vulnerability there. Capital, of course, is leaving the banking system. There's deposit flight. So these credit conditions are tightening up very sharply. Delinquency rates are low, but they're probably going to start moving quite significantly higher. So I think we're in for an ongoing mini banking crisis that may well evolve into something more sinister. So that's, I think, the risk, the sort of tail risk, if you like, to the next 6, 12 months or so.
Okay, very interesting, Harry. We will certainly come back to this development. Thank you so much. Looking forward to talk to you soon again.
Brilliant. Thanks, Stefan. Thanks a lot.
Thanks, Harry. You too. Bye.